Then the other very unique feature with company accounts is the share capital. So our next discussion goes into share capital. We are going to look at the categories of share capital and also look at the process of issue of shares. The categories of share capital include authorized share capital. Now, when we talk about authorized share capital, we are talking about the amount of share capital which a company is authorized to issue by its memorandum of association. The amount of share capital which a company is authorized to issue by its memorandum of association. You all know that when you are at formulation stage, you need to draft a memorandum of association. In the memorandum of association, you will specify the amount of capital that the company is going to issue to its members. So if you agree to that and you sign to that, it means that you cannot raise more than that amount of capital. You cannot raise more than that amount of capital. Now, in certain books, textbooks, or any other material, you will see that the authorized capital is also referred to as the nominal or registered capital. So that would mean the same thing. If we talk about nominal or registered capital, it would mean the same thing. Now, the authorized share capital can be increased or decreased as per the procedure laid down in the Companies Act. The Companies Act stipulates the procedure under which you can increase or decrease the authorized share capital. Again, we continue by saying that a company need not to issue the entire authorized share capital for public subscription at a single time. Depending upon your capital requirements, you may issue the share capital in piecemeal. You may issue the share capital in piecemeal as long as you do not issue more than the amount of your authorized capital. So if you start your own company, limited liability company, you can invite the public to come and buy shares. But what the public can buy or subscribe to is limited to your authorized share capital, which is stipulated in the memorandum of association of the company. Next, we have what we call the issued capital. As we have mentioned, part of the authorized share capital can be issued to the public. So the issued share capital is part of the authorized capital, which is actually issued to the public for subscription, including the shares allotted to vendors and the signatories to the company's memorandum. You know, there are those people we call the promoters. The promoters are the people with the idea. They are the people who champion the formation of a company. In most cases, they are the signatories and they usually have some of these shares. But in some cases, you find that these people promote the company with the intention of presenting it to the public. So if any part of the authorized share capital has been offered to the public for subscription, then that part is what we call the issued share capital. And in the second place, we are saying that the authorized capital, which is not offered to the public for subscription, is known as the unissued capital. This unissued capital may be offered for public subscription at a future or later date. Again, as we've mentioned, for funding purposes, companies issue shares because they want to raise funds. and you find that you don't need to issue all your authorized share capital to raise a certain amount. You may need to just issue like maybe 60% and reserve the 40%. So the 40% is what we shall say is the unissued capital. Then we have what we call the subscribed capital. Now this is part of the issued capital which has been actually subscribed by the public. When the shares offered for public subscription are subscribed fully by the public, it will mean that the issued capital and the subscribed capital are actually the same. It is true that you may invite the public to buy your shares and they may not show up. They may not show up. So it doesn't mean that all the issued capital will be subscribed for by the public. So part of it may remain unsubscribed. However, if all the shares you have issued to the public are subscribed for or subscribed fully, then it will mean that your issued capital is equal to the subscribed capital. Then we have what we call the called up capital. Now when we say called up capital, we are talking about that part of the subscribed capital which has been called up on the shares. The company may decide to call the entire amount or simply part of the face value of the shares. In the second place, we are giving an example here that if the face value, what we may call the nominal value of the share allotted, is 10 and the company has called up only 7, then the called up capital will be 7 per share. The remaining 3 will be collected from its shareholders as and when needed. Yeah, so you may subscribe to the shares of a company. You are allotted maybe 10 shillings in face value. The company may decide to request you to make a payment of only 7 shillings out of the 10. So you can deposit 7 shillings and then maybe the 3 can be deposited later. Again, this goes back to the objective of issue of shares. What is the objective for the company's issue of shares? If it is to raise finances, then they will do the computation and see how much they need. So they will call up a certain percentage of what has been allotted to you. Then finally, we have what we call the paid up capital. Now, you may be requested to make a payment of 7 shillings, but you fail to raise the 7 shillings. Maybe you may pay 5 shillings out of the 7. So that portion in the bullet, we are saying that that portion of the called up capital which has been actually received from the shareholders is the paid up capital. When the shareholders have paid all the call amount, the call up capital is the same as the paid up capital. If any of the shareholders has not paid amount on calls, such amount may be called, or we may refer to that as calls in arrears, and therefore paid up share capital is equal to the called up share capital minus the calls in arrears. So not all the time that the shareholders will have money on their account. You may make a call of 7 shillings per share of what has been allotted, and only part of it is received. So the balance is recognized in our books of accounts as calls in arrears. We can support that with an activity. Our activity 1, we have ABC. We have our ABC Limited, which issued 400,000 ordinary shares of 1 shilling each. A call up of 75 cents per share was made and a payment of 290 was received. Okay, account for the above in the accounts of APC Limited. Account for the above in the accounts of APC Limited. Now, so the issued capital is 400,000. The issued capital is 400,000. Our question here, our activity. We made a call of, out of the 400,000, we made a call up of 75 cents per share. Out of what we issued, the 400,000, of course this is 400 times 1, not so? 400,000 shares times 1 times shillings 1. So that gives us what we call the issued capital. So the called up capital is going to be how much? 400,000 shares times, out of the 1 we are calling for, 75 cents. How much is that, members? So that gives us 300,000 as the called up capital. When you look at our question here, we received payments of 290. Okay, payments of 290. The paid up capital now becomes 200 and what? 290. So meaning that the unpaid or capital not yet paid, capital not yet paid is how much? Okay, 10,000. Now under the assets, you have received money, so that one is going to be recognized in your current assets. Then we have under receivables, you have people that have not paid receivables, which we are saying is the capital not yet paid. Capital not yet paid. This one is a receivable of 10. So it means that from this transaction, the total current asset you expect is a figure of 300,000. Now, because of the rules of double entry, what you recognize here is supposed to be recognized in equity. Okay, what you recognize here is supposed to be recognized in equity. So we have a called up capital of 400,000 shares at 75 each, which definitely comes to our 300,000. So we have different types of capital: authorized, issued, paid up, called up, allotted, as you are going to see. Next, we have what we call the uncalled up capital. Since part of it was called up, so what is the uncalled up capital? So that is the portion of the subscribed capital which has not yet been called up. That's the portion of the subscribed capital which has not yet been called up. As we stated earlier, the company may collect this amount anytime when it is in need of additional funds. When it needs further funds, this money will be called up. Okay, the reserve capital is a portion of the uncalled up capital to be called only in the event of winding up of the company. Such uncalled up amount is called reserve capital of the company, and it is available only for the creditors on winding up of the company. So you may reserve for cases of emergency, like you're winding up and you don't have money, you need to pay some creditors. So some of the uncalled up capital can be transferred to reserve. Finally, we have this illustration where we are showing the authorized share capital, which is divided into issued and unissued. Then it might be issued and subscribed for. You can subscribe, fully pay, and you may have part of it which is not fully paid. So you can. Alright, so that marks the end of our discussion on the categories of share capital. So our next discussion goes into the issue of shares, and I want you to go to the next lecture video that handles the full discussion on issue of shares. If you have any comments on that second lecture, on the second lecture we've had, please leave your comment in the comment section below. I'll be able to respond to your question. So let's go to the next lecture session on issue of shares. Thank you.